Hey everybody, welcome now Stock Trades. In this channel, we love to help retail investors go from gambling and losing money to making strategic investments that will build long-term generational wealth. So recently, I just made a Sofi price target projection analysis, and I received some comments, and I felt like this one deserved a response. So this particular person, we had a thorough discussion, and he was saying that, you know what, I don't think your model accurately predicts the stocks like, for example, Tesla, Palantir, Sofi, like growth stocks, right? So I encouraged them to take a look at my past Tesla videos where we actually were able to predict the stock price, right? And so he was saying, no, I don't think, 1 year out is a great prediction because I don't think, maybe 1 year is not enough time, right? So I was telling him, no, we can predict it a little longer than that. So I promised him I'm going to make him a video, and we're going to go ahead and compare it to our Sofi analysis. So we're going to back test this, right? So we're going to go back in time. I feel like, Back to the Future. We're going to go back in time when Tesla was at 2019, okay? The year 2019, all right? Now, if you don't remember the stock price on December 31st of 2019 was $83.67, okay? We're going to go ahead and do our intrinsic value analysis, right? And these numbers are going to look different because we're not looking at 2020, 2021, 2022. All right, we're looking at 2019. And then we're also going to be looking at 2018 and go back even a year, right? So we have 2018, 19, 20, and 21, 22, right? We're going to have 4 or 5 years projection, and we're going to be able to see how strong is our proprietary model that has been featured on Benzinga, Yahoo Finance, and Bloomberg. How strong is it, right? So first off, what I want to point you out to is revenue. Everyone looks at revenue, right? But what people don't look at is cash flow provided from operating activities, which you can find in the statement of cash flows. Now that I like to look at because I think of it as a prognostic factor that basically is able to predict future free cash flows. Because how do you calculate free cash flow? Well, it's very simply cash provided from operating activities subtracted from CapEx, which then yields you free cash flow. So as you can see here, Tesla became cash provided from operating activities positive back in 2018. In fact, you're able to see a difference here when they went from literally half a billion to 123 to negative 60 million. So you already started to see it trend down, which is why I like to use these analyses, because then you'll be able to see next year in 2019, they became free cash flow positive, right? So what we're going to do is we're going to go in here. We're going to use these numbers for 2019, and we're going to use our analysis here. So look at the trend line, okay? The trend line for the operating activities was up. Now, pretend that's not there. Let's forget that. Let's just look at free cash flow. If you look at our linear analysis from free cash flow, in 2018, it became positive. The business model started to prove themselves, okay? Now, if you look at Sofi, look at where the free cash flow is. It's down in the dumps. It's down. Now, it's just started pausing. But you remember when Chamath sold out here, right? It's because the free cash flow started dropping. He sold 15%, right? To better further allocate his money, okay? But yeah, I tried to explain to that people, and people were resisting, but that's okay. We don't want to reach those people. We want growth mindset people. We want winners. We want people that move forward, okay? So then this particular individual said, you know what? I would love for you to use 30% because, that's better. Well, the problem is if we would have used 30% for Tesla, I used 5% to estimate the estimated free cash flow, and it gave them approximately $1.2 billion, when in reality in 2019, when they actually became free cash flow positive, they were below that. In fact, a great estimate would have been 4%. If you would have used 30%, you would have $7 billion. That's not correct, right? So it's good to be conservative, because if you overestimate, you're going to be overpaying, which is exactly what retail does. They overpay. They buy at the top, and unfortunately, they sell at the bottom. So if I were to give you a nice graph, let's show you this nice graph here. Retail investors like to buy up here, but they never buy down here. They lose conviction here, but they have high conviction here. What I'm telling you is we find the intrinsic value, right? And then you want to buy below it. So let's continue. So we're going to go ahead and take a look at this Tesla stock, and we're going to type this into our intrinsic value calculation. So we're going to pretend it's 2019, and we're going to project out. So we're going to open this guy up, and we're going to say the average free cash flow, which is around 968. We're going to assume that they're going to grow at that rate, right? Because that's what they've been averaging on our estimated side. So they finally got near it. We're going to say we're more confident. We're going to say 968. Now, if Sofi got close to becoming free cash flow positive, and once they became near there, then we can slowly start reevaluating. And essentially the whole point of this is you keep sending these satellite projections out to accurately reflect what the stock price is going to be. So we're going to put 10 years, and we're going to go from 2022 to 2023 in discount, right? Because the stock price is the sum of all future cash flows, all right? And what we're going to be doing now is we're going to go ahead and look at the year 2013, and we're going to look at 2019, right? Because we're in 2019 now, right? And we're going to go ahead and take a look at the revenue here, which is about $2 billion. So that's 2013. And we have 245 right there, 24578, right? Because you have to convert it into millions, 24578. So on average, they're growing about 52%. Now all you got to do is take a look at the outstanding shares, which is 887. And as soon as you do that, you see the stock price of a recession level of 88 to a bear of 204 to a base of 291 to a bull of 442. Now, if you look at the stock price back then, it was hovering at $83. $83, okay? So $83.67. So that means you had a 6% upside on the recession, 145 upside on the bear, all the way up to a 4x your money on the bull. Now, obviously, that was all the way from 2019, okay? Now, the stock price went all as low as $35. So imagine, let's go $35. You would have been able to 1,000x your money, 1,000x your money, right? When the stock price was at $35 freaking dollars back on June of 2019. And based off of this model, we would have been able to predict that. In fact, we would have been able to predict this model all the way up until 2018, because remember I told you about the free cash flow. In fact, we've been able to predict it even higher. The model here says about $1 billion, right? So if we jump this up to $1 billion, then we got a 1,200% return. And again, these are sidetracked before they did their stock split back in 2020, right? When the stock was increasing to, literally going up to the moon, right? But you can see how strong this model is. But yet, I tried to explain this. We gave a 55% rate for Sofi. We went ahead and we used the average. Let me go ahead and show you Sofi here. We used the average, which is 28 million, right? But then, I was like, okay, that's a little bit undervaluing it. Let's instead of 5%, let's go ahead and up it to 10%. So we remember how we upped it to 10%. Then we got 56 million, right? Let me go bring it back. We got 56 million, right? Which is what we did here. We put 56 million. I doubled it. I put more, right? More than I did for Tesla. And even when he put more, the stock price goes from $13 to $29. Ladies and gentlemen, listen. Okay, it's very clear. When the Federal Reserve was printing money, we became so overvalued that, even in our analysis, if you look at Tesla stock, Tesla went above our intrinsic value calculation, right? But obviously it became better, and the projections are even stronger for Tesla. They're building gigafactories, and we have an analysis on that on a separate video of it growing 74%, right? So, but right now, we're in 2019. We're not in 2022, right? This individual said, our models can't predict for diddly squat. I'm telling you, we were able to predict this rise from all the way from 2018. In fact, we were able to predict it in 2017. Like, let's just use 2017 numbers. Very, very simply put, let's just use 2017. So now let's go ahead and make this here, okay? And let's use 587 for the free cash flow. So let's go back to our calculation. Let's go here, and let's change the free cash flow to 587, okay? 587. And now what we're going to be doing is we're going to change the revenue in 2017, and we're going to have them grow at, 11,758. And we're going to do 2017. 2017, 55%, okay? And look at that stock price. And then if you check Tesla back in 2017, let's check Tesla back in 2017. 2017, they were trading around about 50 bucks. So we can go ahead and put 50 bucks. Look at that. You see that? Which is why it's important to continue. To all my mastering students out there, thank you for giving us a chance with our technology. What you do is you do this every quarter, every time the company reports, every year, and you send off these projections. And then you slowly, accurately provide what is the actual value of the business. And the beautiful part is you can actually lower this and lower your assumptions so you know when they get out, so you know when the stock is overheated, so you don't lose money. Rule number 1 of Warren Buffett investing is do not lose money. Rule number 2 is follow rule number 1, and that's how you make a shit ton of money. Okay? So I hope this was helpful. There's a lot of people out there that unfortunately do not listen. And unfortunately, those are not the people that we're trying to reach. We're trying to reach the people that want to make a difference in their life. If you look at my story, I started from the bottom and I clawed my way out. Right? And I'm trying to help as many people. I'm trying to take as many people with me as I can, right? This is a new language, and unfortunately, we live in a world that does not emphasize mathematics, okay? So I hope this was of educational use. If you like our content, please don't forget to subscribe, like, comment what you think. And also, if you would like to consider our products, we have been featured on Bloomberg, MarketWatch, NASDAQ, Benzinga, Yahoo Finance. Again, every money that gets invested in this gets reinvested back into the business. I'm not taking anything out of it. I'm going to be a successful physician going in to help patients. This is not where I'm going to get my bread and butter. This is not where I'm going to make my living. This is a passion to help the historically marginalized, to help retail investors that want to change, that don't want to get swindled by Wall Street, that don't want to get swindled by other retail investors who just want you to hold to make themselves feel better so their failures don't turn into failures because they're, suffering from the herd mentality. If you want to make money, it is hard. You have to have a contrarian perspective. An investor, when everyone's rushing to the doors, that's called the fight and flight. The sympathetic nervous system gets activated. The adrenals, which sit above your kidneys, start activating and they start releasing norepinephrine, and epinephrine, which stimulates the body to run. As an investor, you have to think to yourself and say, wait a minute, let me look at the numbers. Let me look at my conviction. Let me look at the mathematics. And this is exactly what we teach. So it is a privilege and honor to serve you, and I'll see you on the next one.